let's talk about investing. I want to walk you through a powerful thought experiment from Angkor Wariku that kind of flips a common belief on its head. We're going to look at two completely different stories for your money, and you might be surprised to find that the safe option, well, it could be the riskiest one of all. All right, so let's jump right in with a question for you. Imagine you get your hands on 1 lakh rupees. The catch is, you can't touch it for 20 years. Where do you put it? It seems like a simple choice, but as you're about to see, this one decision can lead to two wildly different futures. Okay, so let's break it down into two paths. Path number one is what we'll call the safe route. You know, the classic fixed deposit, or FD. It's low risk and you get a steady, predictable return, say around 6.5%. Then you've got path two, the risky route, a small cap mutual fund. This is way more of a roller coaster, but it's averaged a much higher return, around 20%. Let's start with the one our parents probably would have told us to take, the FD. I mean, it feels good, right? It's secure, it's predictable, you lock your money away, and you know what you're going to get. So what happens to our 1 lakh? Fast forward 20 years, and that 1 lakh has turned into 3.5 lakh rupees. Hey, not bad. You've more than tripled your money, and you did it without losing any sleep. On paper, this looks like a solid, sensible win. But, and you knew there was a but coming, didn't you? That nice, tidy number on the screen, it isn't telling you the whole story. There's a villain lurking in the background, a silent thief that completely changes the ending. And that villain, my friends, is inflation. It's the sneaky, invisible force that's always at work, quietly eating away at the value of your money. So what exactly is it? To put it really simply, inflation just means your money buys less stuff over time. The price of everything, your groceries, gas, movie tickets, it all goes up. So to figure out how much our investment really grew, we have to account for this loss of buying power. And this is the shocking part. Once we factor in inflation, let's say an average of 6% a year, that 3.5 lakh is only worth about 1 lakh and 9,000 rupees in today's money. Let that sink in. You started with 1 lakh, and after 20 years of playing it safe, your money has really only grown by 9,000 rupees. So that FD, it felt safe, but it failed at its most important job, making your money worth more in the future. Now, let's see what happens when we take path number two, the high-risk, high-return world of the small cap fund. Whoa, now this is a different story. This is the magic of compounding at a much higher rate. After those same 20 years, your 1 lakh has absolutely exploded into 38 lakh rupees. The difference is just, well, staggering. Of course, to be fair, we have to ask the same question. Our old villain, inflation, doesn't play favorites. It's going to take a bite out of this big number too. So what's the real value once we adjust for it? Even after 20 years of inflation chipping away at it, the real value of your investment is still a solid 10 lakh rupees. Think about that. You put in 1 lakh and you came out with 10 times the buying power you started with. Now that is creating wealth. Okay, let's put these two final numbers, the real inflation-adjusted numbers, right next to each other. This is where the story really hits home. I mean, this chart says it all, doesn't it? On the left, you have the safe path, which barely moved you forward from where you started. And on the right, you have the risky path, which created actual, meaningful wealth. The goal of investing isn't just to get a bigger number, it's to make sure that number grows faster than prices do. So, what's the big lesson here? Is it just ignore your parents and throw all your money into the riskiest thing you can find? No, of course not. It's a bit more nuanced than that. And let me be crystal clear here. This is not financial advice. It's just an illustration of a principle. Small cap funds can be incredibly volatile. They can go up and down like a yo-yo, and putting all your eggs in one basket is pretty much always a bad idea. The real lesson, and this is the core of what Angkor Wariku is saying, is that you have to understand both sides of the coin, the potential return and the risk you're taking to get it. The safest looking option might actually be the riskiest one for your future if it can't even beat inflation. And so we're back where we started, but with a totally new way of looking at things. The real risk in investing isn't just about losing your money tomorrow, it's about losing your buying power over 20 years. It's not about choosing safe versus risky, but about finding the right path for your own goals. The real question isn't just where to put your money,
But are you investing to stand still, or are you investing to actually move forward?